So there are three basic ways of looking after your own super fund if that's what you've chosen to do. The first one, which we've covered in another video, is don't do it. Leave it up to an industry fund or a large retail super fund to do it for you and let the professionals do it. The other option is do it yourself. We'll cover that. But the one in the middle is to use a financial professional. And what happens a lot of time is that you need financial advice when there is a change going on in your life, or if you've never had financial advice. Financial planners are highly trained, and there's a lot of training and compliance involved in becoming a financial planner these days. They are highly trained to tell you how to set yourself up, what entities, the tax implications of all sorts of things, your options if you're going to look after your investments, and that's a fabulous service. But what often happens, and I'm just going to point out possibly the one structure that you might get caught in that maybe you should think about before you do get caught in, is a lot of people who go for financial advice, and as I say, there are events in your life, be it divorce, a death, an inheritance, there are moments in your life, a marriage, where you decide that you need financial advice. So you go and see an accountant or a financial planner, and what happens is that they will take a lot of information in, they will do a financial plan for you, they'll charge an amount of money. When we're in financial planning, the financial plans, it just wasn't worth doing one unless a client was paying over $10,000 for a financial plan. To get that involved, do that much work within a compliance regime, which is quite intense for financial planners these days, it just wasn't worth it for a small sum of money. You literally can't go to a financial planner, expect to pay a couple of grand and get decent advice or a financial plan. So most people, they go along and they get their financial advice, you have to pay quite a lot for it, but then what happens is part of the financial plan will probably include, and sometimes you can get it on a DocuSign, so you're 3 clicks away from signing up to a relationship with the financial professional, which lasts however long it lasts, but it lasts beyond the advice that was given. So it lasts beyond the financial plan. And in this structure, some financial planners will end up looking after your investments for you. And that will come, of course, at a fee. Let's say it's 1%. It might be less than that, it might be more than that. But let's say it's 1% of your assets under management. Now you've got a question is a percentage fee of asset under management, so if you've got $1 million, they might charge you 1% a year. Is that right? Should you be paying that? It seems odd to me that you should pay a percentage on assets under management when it's the same amount of work, whether it's $1 million or $5 million. Or $500,000. But anyway, and the likelihood is that they will then, in order to manage the super fund, put you onto one of the major platforms which allows them to click buttons and change what you're invested in. And they will do that for you, and that's what you're paying for. But those platforms charge admin fees as well, and that may be 1% as well, maybe 0.5% to 1%. 0.67 would probably be normal. So you're paying a financial planner fee, plus you're paying the admin fees for that platform. And then the other bit is the likelihood is that the financial planner's advice will involve you buying managed funds, say 5 carefully selected and sensible. May have international equities involved, it may be domestic equities, maybe certain types of domestic equities, depending on what your preferences were, what your risk appetite is. You will get a collection of managed funds which suit you and in various percentages. And that is how they will do the asset allocation for you. But the reality is that you have then paid a fee, say 1% to the financial planner. You've paid maybe 0.6 to be on the platform, that's 1.6%. And then you're paying the funds management fees as well, which could be 1 to 2%. So maybe you're paying, if you add all this up, you may end up paying 2, 3.5%, 4% even, depending on what managed funds you're in order to be invested. And whilst that comes with some benefits, your 1%, you'll get an annual reassessment, if not more. You'll get an annual reassessment of what your position is. You'll be able to see on your platform, that's what you're paying for, 24/7. You'll be able to see what you're invested in, how much money you're making or not making, how it's going. Transparency, but you're paying for the transparency, and you're also going to be able to make suggestions because you've got a financial planner that you're paying money to. You can also probably tap them for financial advice, and I suggest you do, because this is what you're paying for. You'll be able to ask them, ring them, and have a relationship and ask them about various events that happen in your life, and that will probably all be included in the 1% fee. So you're getting a value for money, but the reality is you may end up paying 3.5% in order to be in the market itself, which of course you could these days, if you were doing it yourself, minimize those fees by just paying, if for instance you were in ETFs, the fees can be anywhere from 0.2% or even lower on some of them. So you can avoid these fees, but this is possibly the most lucrative structure in the industry that you can end up in, is with a financial planner on a platform invested in managed funds, and a lot of people know they're already there. In which case my advice to you is there's nothing wrong with that. The beauty of this is that you are in the hands of a professional. They do know what they're doing, but they will tend to be compliance paranoid. So they won't do anything risky for you. They will not blow you up, and they will spread your money across a number of asset classes, markets, a number of stocks. By the time you come out of, well, by the time you look at what you're invested in, if you've invested in 5 managed funds or more, you'll find you're effectively holding 3,000 stocks in 5 countries in 5 asset classes. So you're not going to get blown up. For instance, the average balance fund, when the market fell 35% in 30 days in COVID, that might be a 30% drop. The average balance fund dropped about 8%. So even one of the worst moments in the market in a decade wasn't really that painful under this sort of structure. So the beauty of it is whilst you're paying a lot of fees, you've got financial planning advice on tap. You've got a relationship with a professional who can hold your hand, and you've got a spread of investments which is essentially as low risk as you can get in the market, and you can sleep at night, and you've also got somebody else to blame if it all goes wrong. So that's the option in the middle, but worth knowing that that is possibly the highest fee paying structure in the market for an individual. And there is a bit of a link between asking for a single piece of financial advice and suddenly finding you're paying tens of thousands of dollars every year to a financial planner. And you just need to understand that that is the goal when you go in and ask for financial advice. Very few financial planners seem to do. If I was a financial planner and wanted to break the mold, I would put up an ad which said, "I only give financial advice, I don't look after your investments." And that would be the best bits of a financial planner, I think. But under this structure, you can sleep at night, nothing wrong with it. But just understand that is possibly the most fees you can pay in this industry, which might add up to 2, 3, close to 4% if you're in some wild managed funds or on a really expensive platform. And if you take 2% and compound it for 10 years, it's actually over 20%. So over 10 years with a 2% fee, you're giving away 20% of your potential capital if you could emulate the same performance yourself without 2% of fees. So a little explanation of the second option for looking after your own super is to use a financial professional. It is expensive, but it is good. You can sleep at night, it won't blow you up, and that may suit some of you.